The JP Morgan Equity Premium ETF, ticker symbol JEPI, pays an 8% dividend yield and pays monthly dividends. In this video, we'll do a full review of the JEPI ETF. We'll go over what it is, how it works, and most importantly, if it deserves a place in your portfolio. And we're gonna get started now. How's it going, everybody? Welcome back to the channel and yet another video on a high dividend yield ETF. This time we're talking about the JP Morgan Equity Premium ETF, which is ticker symbol JEPI. I put a poll up for my subscribers and this is the ETF that you guys voted you wanted to see a review of next, so here we are. And to get started, let's look at the JEPI ETF's strategy, its holdings, and how it all works, how it manages to deliver that 8% dividend yield. JEPI is an ETF that's been around for just over a year at this point, so it's really new on the scene, but it's been around in a mutual fund form that was only available to JP Morgan's high net worth priority clients for much longer. The aim of JEPI is to provide current income while also leaving room for capital appreciation. So it differs slightly from an ETF like QYLD, where you're just going for income. Unlike most of the things I talk about on my channel, JEPI is an actively managed ETF. That means it has portfolio managers actively running the fund and implementing the strategy they set out. So exactly what is the strategy of the JEPI ETF? We can break JEPI's strategy down into two segments: the growth segment and the income segment. And let's start with growth first. For growth, the fund managers of JEPI hand select a basket of stocks from the S&P 500. They're buying stocks that they determine are undervalued based upon a fundamental analysis at their current prices. And with the stocks they're picking for the JEPI ETF, the aim is to capture the majority, not all, but the majority of the upside of the S&P 500 index, while also limiting the downside risk. So essentially, those two fund managers are picking a selection of stocks from the S&P 500 that they think will deliver most of the same growth of the index, yet are a little bit safer than average and won't fall as hard as the rest of the index should that happen. And the next segment to the JEPI strategy is income. And that's the reason we're all here, that flashy 8% dividend yield, those monthly dividends. How do they make that happen? So to create the income that JEPI gives off, the fund invests up to 20% of its overall holdings into ELNs, or equity-linked notes. Now, if you haven't heard of ELNs before, you're not alone, because neither had I until I started researching this ETF. But I'm sure you're all somewhat familiar with the term derivatives, and an ELN is a type of derivative. If we go to the JEPI fund prospectus, ELNs are structured as notes that are issued by counterparties, including banks, broker-dealers, or their affiliates, and they're designed to offer a return linked to the underlying instruments within the ELN. The ELNs provide recurring cash flow to the fund based on the premiums from the call options that the ELNs write, and are an important source of the fund's return. So while that sounds really technical and complex, what you really gotta know is essentially it's working very similar to a fund like QYLD. But the important point there is that the bulk of the income being paid back to us investors are essentially premiums from the options contracts that the ETF is writing. So that's basically the strategy and how JEPI works, but what are the holdings of the JEPI ETF? And when we take a look at the top holdings of the JEPI ETF, we can see right there at the top those odd looking things that make up about 16% of the fund's total holdings. Those are the ELNs. That's what JEPI is using to create that income for us investors. Those notes make up about 16% of the fund. After that, we get into the familiar names we know and love from the S&P 500. We've got some Google, we've got Target, we've got Microsoft, etc. And individually, each of those makes up a little less than 2% of the overall fund. So at this point, we gotta be wondering about JEPI's fees. JEPI is an actively managed ETF and invests in some rather complex out-of-the-box investments. That seems to be two strikes against it. It's gotta eat you alive with fees and expenses. But shockingly, that's not the case at all. JEPI's expense ratio is only 0.35%. That's almost half as much as a fund like QYLD, which is sitting at 0.6%. And QYLD claims to be passively managed, where JEPI is actively managed. And normally with these actively managed funds, you're seeing really high expense ratios. So the fact that it's only 0.35% is extremely good. So come on, Jay, let's get to it. What's the catch? It's gotta be the performance, right? I mean, there's no way this thing can perform that well. Since its inception a little over 12 months ago, JEPI has returned about 28% overall. And I'm gonna keep comparing it to QYLD because that's another income ETF we looked at, another one that's very popular and similar in strategy to this. And over that time frame, JEPI outperforms QYLD by about 7%. Now, JEPI, like QYLD, and a lot of these other high dividend income focused ETFs we're gonna look at, they will lag the S&P 500 index or a broad index fund like VTI. That's just gonna be par for the course with these. If you're liking this JEPI review, hit the like button down below. It really helps out the video. Leave me a comment as well if there's any other ETFs you want me to take a look at in the future. Now let's take a look at the reason we're all here. The JEPI dividend. JEPI's dividend is the big draw to the ETF. It pays out well over 8% currently, and it has the added benefit of making those dividend payouts on a monthly basis. So you're getting a payout every month. You don't have to wait every 3 months to actually get your dividends with JEPI. Is JEPI's dividend sustainable? Can you count on it? And like we saw with QYLD, yes, the high dividend yield isn't a farce because we're relying on premiums from options contracts to generate that dividend, and we're not taking, the earnings of a company, a business to pay out a dividend. Yes, that higher yield is safer, it is more stable. Like we see with QYLD and like we'll see with all these other income ETFs that generate income this way, the yield will fluctuate because the premiums you get on options contracts fluctuate with the market, but you will be able to count on higher yields than your typical dividend stock or your typical dividend ETFs. Now, what's the tax situation with JEPI? Let's look at the JEPI taxes. And straight from the JEPI fund prospectus, the JEPI ETF distributes all of its net investment income back to its investors. And net investment income is generally taxed as ordinary income. So the premiums from these option contracts, that kind of income being passed back to you is probably going to be taxed at the ordinary income rate. JEPI also holds a bunch of stocks like we saw Google, Microsoft, Target, etc. Any of those stocks that pay dividends that JEPI passes along to us, those will be taxed at the dividend tax rates, and any capital gains on stocks that the JEPI ETF holds for more than a year and then sells will be taxed at the long-term capital gains rate. So it's becoming a theme when we look at these income-producing ETFs that the tax situation gets a little complicated, gets a little muddled. And again, because the JEPI ETF is so new, it's only been around for a year, we don't have a lot of history to look back on to see how it was actually taxed. So we're just gonna go with what they tell us for now and have to trust that at the end of the year, we're not gonna get crushed by a huge tax bill. Is JEPI a buy? Who should be holding the JEPI ETF? And as always, I have to qualify this. I'm just a guy on the internet. I'm not your financial advisor. Your situation is different than mine and everyone else's. So look into the details as much as you can from as many sources as possible and make that decision for yourself. But if you're someone looking for current income, you want your investments to be giving you as large of a paycheck as possible today, you're not necessarily concerned with building as large of a portfolio as humanly possible 20, 25 years from now, then JEPI should be a strong consideration for you. From all the research I've done, everything I've looked into the JEPI ETF, it really does seem like a solid investment, a solid choice. You wouldn't be making a huge mistake by adding it to your portfolio. And if you're looking for more videos on dividend income ETFs, check out these two right over here. I really think you'll enjoy them. I hope to see you there. Thanks for watching.